Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at some growth-focused tech stocks to possibly consider buying ahead of their upcoming earnings releases. And that is Shopify, Roku, and Fiverr. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into those three growth-focused tech stocks, it's always nice to start with a broader market overview. So the S&P 500 hit new records on Tuesday morning, and the fundamentals appear to provide a pretty bullish setup for the rest of 2021. So I'm just going to quickly go over the broader bullish case before we then jump into Roku, Shopify, and Fiverr. So first, the Fed once again has committed to doing all it can to boost the economy and the market. As the coronavirus still hurts so many businesses, this means that low interest rate environment likely sets up that TINA, or there is no alternative buying, for the foreseeable future. Meanwhile, the prospects of increased government spending under the new Biden administration seem pretty likely, and the coronavirus vaccine rollout could help the hardest hit areas of the economy within that travel and leisure area rebound by the end of the summer. And the fourth quarter earnings results have come in far better than expected, and positive guidance continues to set up in a bullish case and justify why the market's able to climb to new highs again and again and again to start 2021. So overall, the S&P 500 earnings have turned positive for the fourth quarter. This has been driven by the tech giants, Apple, Microsoft, Amazon, Alphabet, as well as some other strong showings throughout the index. And as we mentioned, the first quarter outlook for 2021 continues to improve. So at the moment, our Zacks estimates are calling for Q4. So the current quarter that we're seeing reports for right now, we're calling for about 3% earnings growth on about 2.6% higher revenue. So just to give you a sense of how quickly that's changed from where we were, so in mid-December, we were calling for a earnings decline of over 11% for Q4. And now we're calling for about 3% growth, and then all the way up to 18% growth in the first quarter of 2021. And then against that easy to compare Q2 of 2021, we're calling for 48% bottom line expansion. So that gives a really positive setup for the earnings outlook, along with all of the other bullish fundamentals we discussed. And we talked about how tech is continuing to shine and able to grow despite all of the broader rough economic conditions that are remaining for many different areas of the economy. So with this in mind, we are going to jump into Shopify, which trades under the ticker SHOP, S-H-O-P. The company was one of the stars as the market surged off those March lows of last year. This is alongside Zoom Video and others that were able to benefit from those coronavirus conditions. The stock has soared about 175% in the last year, and it had cooled off over the last 6 months or so until it started breaking out of a slump at the end of January, and it's now up about 30% since January 29th to sit right at all-time highs. And this is heading into the release of its Q4 results that are due out actually before the opening bell on Wednesday, February 17th. So in this shortened week, we're seeing Shopify set to report Wednesday morning. So tomorrow morning, depending on when you're listening to this, before the opening bell. So now let's dive into why Shopify might be worth buying right now. Digital commerce has been growing for years, and we all know that the pandemic helped spur the broader adoption among many businesses that maybe had been holding out on really ramping up their e-commerce and digital futures. This is the massive expansion that's set to benefit FedEx and help Amazon continue to gobble up more market share. And despite everyone from Target and mom and pop shops rolling out various e-commerce offerings, it's still the early days. So e-commerce accounted for only 14% of total U.S. retail sales in the third quarter. That was down from a record of 16% in the second quarter of last year. And it's up from the 2019 levels, but still at under far less than 20% of total domestic retail sales. Digital commerce clearly has miles of runway left to grow. With this in mind, Shopify helps companies adapt to the future of retail, and they've been doing this for over a decade. and they claim to power more than 1 million e-commerce businesses. Many of those are obviously small entrepreneurial businesses, but the firm helps build and maintain and grow e-commerce presence, and they make money from recurring subscription fees and add-ons. They currently offer different tiers, one that's aimed at entrepreneurs, as we mentioned, and then as well as small and medium-sized businesses, and then one that's geared to that higher volume merchants and bigger businesses. So the most basic package starts at about $29 for sellers with a 2.9% transaction fee. The companies also continue to partner with heavyweights from retail, such as Walmart, as well as the tech world, such as Facebook. And it was already on a pretty nice long run before the coronavirus. So Shop stock had surged from $30 a share in 2016 all the way over to $500 before the coronavirus crash. So before any of this, and Shopify's sales had grown as well. So 2019's roughly 50% revenue growth actually was its slowest since it went public in 2015 at 50%. So with this in mind, the company is expected to see its revenues grow about 80% in the fourth quarter to about $910 million, which is projected to lift its adjusted earnings by 181% to $1.21 per share. Meanwhile, its full year 2020 revenue is projected to climb 81% to about $2.9 billion, with its earnings per share projected to jump all the way from 30 cents to $3.69 per share. And this top line growth of what we're calling for is 81% this year would beat, as we mentioned, 47% last year, 60% the year before, and 73% the year before that. So big growth is expected. And then if we look ahead to next year, the company is expected to climb another 32%, or about $910 million above our 2020 estimate. So continuing to grow. Obviously, it's get hard to recreate the conditions of this year, but to grow by $900 million in sales over this year's projection is still pretty impressive. The company has also consistently crushed our earnings estimates, including some really big beats during the pandemic. And its broader earnings revisions help it land a Zacks rank number 2 buy at the moment. With this in mind, it does trade at a solid premium compared to Amazon and Etsy, but growth-minded investors with longer-term outlooks might want to consider Shopify, since businesses big and small must grow online in order to thrive. And we should note that about 15 of the 27 brokerage recommendations that we have at Zacks come in at a strong buy, with 11 more at a hold. So analysts are pretty high on Shopify. Obviously, there could be some near-term selling pressure with the stock climbing so much heading into its earnings release on Wednesday. And that's actually going to turn out to be the case with all three of the stocks we're talking about today. So long-term investors, certainly there's some more legs left in Shopify, but there could be some big near-term selling pressure, even if it's able to, quote unquote, impress Wall Street with a big beat or strong guidance. Just it's gone on such a big run. So now we're going to move on to streaming company Roku, and that trades in the ticker that's actually its name, ROKU, and it is set to release its fourth quarter fiscal 2020 financial results after the market closes on Thursday, February 18th. So after the closing bell on Thursday, the 18th, we're going to go over Roku's simple pitch to investors in Wall Street and consumers. So Roku, which went public back in 2017, sells small devices that plug into TVs that allow users to watch streaming TV content from various services. The company also sells tech that's built into smart TVs from various companies. So Roku was the number one selling smart TV in terms of OS. So its operating system built into TVs from various companies. They're not selling their own Roku televisions, but they are Roku-enabled TVs. The company said they were the number one smart TV in the US in 2020 with nearly 40% market share. The company's also selling wireless sound systems that compete in a market alongside Sonos and others. And along with its devices and its streaming TVs, Roku is able to make money from advertising by selling ad space across its marketplace. This allows marketers to buy targeted ads promote their various streaming offerings and more. And it's able to attract advertisers through its Roku channel that allows users to watch free ad-supported streaming movie and TV shows. So this is really going to be the big pitch to investors going forward, is that ability to attract advertisers. As more and more people disconnect from legacy media, advertisers need to find consumers wherever they are, and they are on these digital platforms. So Roku also landed in early January the streaming rights to all of the short form shows that the now defunct Quibi created. So this could help it add users to that Roku channel, as we just mentioned, while continuing to increase its appeal to advertisers. And we should also note that it's slowly trying to expand its international business as well. So with this in mind, the company did release some of its preliminary Q4 results already. So it said it added 14 million, or about 38% more active accounts in 2020 to end the year with 51.2 million. And its streaming hours climbed about 55%. And if we look as a whole, sort of the broader streaming revolution that helped propel Netflix to one of the best performances of the last decade was clearly accelerated by the pandemic. And as we mentioned, it's the future of television going forward. So Roku said that roughly 33% of U.S. households have cut traditional pay TV, and some projections call for that figure to climb by over 50% by the end of 2024. Netflix had a booming year in 2020. It ended the year with over 204 global paid subscribers. We saw Disney destroy its own original growth outlook since Disney Plus launched in November of 2019. The company initially projected that it would hit between 60 to 90 million subscribers by 2024, and it already hit 95 million by the end of January. So this was when they just released their results last week. So they were calling to hit maybe 90 by the end, or by 2024. They've already hit 95 million. And now they're forecasting that they could get all the way up to 260 million subscribers by 2024. And it's not just Disney and Netflix. We know that Apple's in the space. Amazon Prime is obviously in the space. HBO Max, NBC Universal's, Peacock. We have various other services, and Roku stands to benefit from all of this growth. And it doesn't really matter if any of these come out as the winner, but it's also always worth pointing out that it's not an Apple TV or an Apple Music versus Spotify thing here, where lots of people have multiple services. So there's not just going to be one Netflix winner, because people who have Netflix also might have Amazon Prime and HBO and Disney Plus. So, those bills can rack up, but that digital space is continuing to grow. And obviously Wall Street has loved this stock. It's up nearly 900% in the last 3 years. This includes a 260% jump in the last 12 months and a 20% climb since the end of January. And we saw it hit new records on Tuesday of about $487 per share for Roku. This large run has put it in that overbought threshold in terms of the relative strength index. So it sits just over 70, when 70 is often considered that overbought area, and then any number below 30 is considered oversold. And it's rarely gone below 50 during the past 10 months. So it swung between 50 to 70 till it gets a little sold off, and it's sort of oscillating in that area. So therefore, there could be some near-term selling pressure, even if Roku posts strong results and provides strong guidance. As we mentioned, it's the same with Shopify, and it's going to be the same with the last company we talked about, Fiverr. So looking back quickly before we look ahead, Roku's 2019 sales were up 52%, with its ad-heavy and subscription-focused platform sales up about 80%. So looking ahead, we're calling for its Q4 revenue to jump 50%, which is projected to help cut its adjusted loss to 8 cents per share from 13 cents per share last year. Overall, its 2020 revenue is projected to climb 55% to about 1.8 billion. So this would see it growth outpace last year's growth and 2018's 45% growth. And if we look ahead to 2021, we're calling for another 37% growth above our current year estimate. Roku is projected to post a larger adjusted loss this year, but it's then expected to shrink that loss in 2021. And the company's overall earnings revisions have trended in the right direction, and it posted a surprise positive earnings results last quarter, so that could spell good news going forward. Roku currently earns a Zacks rank number 2 buy, along with an A grade for growth in our style score system. And we should note that Roku is trading at about 24 times forward sales, which marks a big discount compared to other high flyers such as Zoom, which is trading at about 35 times at the moment. So as we mentioned now a couple times, there could certainly be some near-term selling pressure given its run. Yet those with a longer-term view might want to take a chance on Roku for its ability to grow within this booming streaming TV market. And let's not forget that the earnings season has been really strong for that broader tech space. And now we're going to close with a look at Fiverr, which trades under the ticker FBRR. So we all know that the coronavirus has created a world where people have been working from home, doing school from home, doing as much as possible if it's allowed by your job, or even possible at all by your job. Obviously, if you have to do something that's not done digitally or remotely, you can't do it. But it's created a world where it's that work from anywhere thing people have been talking about for over a decade, and it kind of seems like it might take hold as the pandemic has normalized a lot of that. So obviously, we see that e-commerce and software has been the big winners of the coronavirus so far, especially off those March lows. And Fiverr really joins together multiple of these secular trends. So it's that SaaS industry, and they actually promote what they call a service as a product model, which is relatively unique in a pretty crowded SaaS space. So the Tel Aviv headquartered firm, which was founded back in 2010, essentially creates what it calls an on-demand e-commerce-esque experience that makes, quote, working with freelancers as easy as buying something on Amazon. So it connects people who need freelance work done on everything under the sun with people in a pretty straightforward way. The basic premise is that small businesses and organizations can easily connect with people and freelancers for what they call defined gigs, from graphic design to programming to digital marketing to translation. And as I mentioned, pretty much anything you can think of. The company is focused on business style digital services. Its catalog expands 8 categories, and it went from 8 categories all the way to over 400 categories across nearly a dozen verticals. And as we mentioned, pretty much anything you could want someone to do that's able to be done on a computer and sent digitally, you can get done via Fiverr. The coronavirus has really highlighted its offerings as more businesses look to adapt to the current situation. And meanwhile, millions of highly skilled freelancers, as I mentioned, can now literally work from anywhere. And maybe it's going to encourage more and more people in this remote environment to do more of these even side jobs, if you like. So Fiverr estimates that the freelance market in the U.S. is worth about $750 billion annually, with its addressable market at more than $100 billion in the U.S. alone. And Fiverr does stress in all of their marketing and in any analyst calls that they're certainly not trying to hire temp workers. You're buying defined service-based products, so it's not just a temp service. It's defined gigs. There are transparent pricing and due dates, and the firms can browse various options for whatever they're looking for. You can see transaction history and reviews, and you can look at past work portfolios. So it's pretty user friendly. I've actually scrolled through it myself a few times just to get a sense of how this site works and how easy it is for businesses and freelancers to use. So the company, if we look back, it went public in mid-June of 2019, and it fell for a few months after it popped on its market debut. The stock overall, though, has soared 1,000% in the last year and 75% in the last 3 months. And it's also surged to new highs, as we mentioned with a couple of these stocks today, to about $336 per share on Tuesday. So looking ahead, we're calling for its Q4 sales to climb 83% to about $54 million. And then we're calling for it to swing from an adjusted loss last year of 8 cents all the way up to positive 12 cents per share. And then for the full year, we're calling for its sales to jump 75% to about $188 million, and it to swing from an adjusted loss of 58 cents per share all the way up to 27 cents per share. we're calling for it to then jump all the way to 75 cents per share in the bottom line in 2021, and then post another 33% sales growth in 2021 as well. So some big top and bottom line growth both this year and next. So this year's revenue growth figure would top last year's 42% growth and then compare pretty favorably in 2021 as well. The company's also crushed our earnings estimates by an average of about 120% in the last 4 quarters. The stock is currently a Zacks rank number 3 hold. So with this in mind, clearly most people and many people are hoping that life slowly returns something closer and closer to normal, but clearly a shift appears to be underway. And even if everything goes well on the vaccine front, there could be a pretty logical future of people working in this more work remote world. And it's been proven with many firms that this remote environment has been relatively seamless. So we're in a digital economy, and Fiverr is operating right in the center of that digital-centric economy, and it certainly fits the bill as a company that looks ready to grow for years and years to come. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.